Hello everybody. So 2 videos ago I did a video about my unsuccessful track record with value investing thus far, and after some digestment, what I think were my biggest mistakes with value investing. And I said that my biggest mistake, I mentioned it briefly, but I said I really want to do a separate video about and do a deep dive into this subject and to have like a lengthy discussion about it. So if you haven't watched my previous video, I'll link it somewhere here. And this is it. This is the video about my biggest investment mistake, which I think was that I didn't have enough target stocks and I haven't looked at and researched enough companies. And I feel like this a lot of the content in this video is gonna be really obvious, but I do want to talk about it just to mention it, and I think there's nothing really new about it, but I think it is still a pitfall that if we're not aware of it, we might fall into it. And just to lay the groundwork for myself also, why I do want to do some kind of a shift in my strategy, in the way I approach investing and researching and stock picking. So I think that of course we should research as much companies, as much investment opportunities as we can. But for me, at the time, after doing a lot of studying and reading a lot and really absorbing a lot of information, a lot of advice about investing, my mindset at the time was that I'm not going to try to understand all the markets and all the stocks and all the companies. And for me, it's like I think it was influenced also by Phil Stone, Rule Number 1 book, that you kind of there's nothing wrong with it, but you kind of need to have your few target stocks, a few target companies that you like, you research, you understand well, and put them in your target list and wait for them to become value opportunities with a good margin of safety for the price to drop. Either catch them already, of course, when they're undervalued. So that was my approach at the time, and what I tried to do was to build this bank of companies I really know well, which I do a really deep analysis about, and as I said, patiently wait for them to become be at a good buying price. But my whole point in this video is that I feel like it didn't work quite well for me, and it comes at a price where there are many disadvantages to this approach, and that's what I want to digest in this video. So my biggest, most prominent investment mistake that I did was with SolarEdge, which I already did 2 videos about. I'll link the last one somewhere here. But what I feel was really the biggest pitfall for me with SolarEdge, and I already mentioned in my previous video how if I would have been honest with myself, I would not invested it at all, where something in me knew that it was a company without a moat, that I really have no confidence in its future, in its market position in the future, in its profitability and its success long term. And but something in me ignored this because I didn't have much other options, and then I feel like it was a pitfall I fell with maybe all of my investments or most of them, but I still feel like the other ones are still good businesses long term, whereas SolarEdge is not necessarily. It could turn out to be one, but I have less confidence in being one than the other ones. So it's really the one that I'm like focusing more to trying to understand in hindsight what I was thinking and feeling at the moment. So that's about SolarEdge. So what I think, like more detailed, happened for me with SolarEdge was that at the time where I invested in SolarEdge and I placed a really big position, I committed a lot of capital to it. I was sitting on a lot of cash and I was really under pressure to deploy it already. And I didn't want to invest in ETFs. I'll maybe do a separate video about why. And I didn't have a lot of target stocks. I researched only a handful. I wasn't really consistent also with researching. I wasn't doing like a stock a week or a stock a month. I wasn't really consistent, and we'll get into the consistency thing also later in the video. But I just didn't have a lot of options, so I was waiting for SolarEdge to drop. I knew it was overvalued, but when it got to 220, and at the time, now it seems super expensive, but at the time it was seemed like a reasonable price for the growth it had at the time, and before we knew that everything was about to unveil. But still, I feel if I had more options, I don't know if I would have invested it at all, like I said, and I for sure would have placed a smaller position in it if I had more choices, because I would realize the risks that are involved with it. And it's not like I didn't know. I knew it was a super cyclical stock it is sensitive to the overall cyclicality in the market, and that it has its own cyclicality in the solar industry. And it would be influenced by interest rates. I didn't know how much, granted, but I did know it would be influenced. I can give the case what I thought. It's not like I thought it was a bad investment and I still placed it. I had my investment thesis also, but again, I would have, if I had more options, I feel, I would have placed a moderate position in it and spread to other investments also. So I really want to talk about the disadvantages, the problems when you research really too little stocks. And I know it might be obvious, a lot of it, but for me at the time it wasn't that obvious, and maybe the strength of those arguments was not obvious, just how much it influenced me and my decision making and my performance also. So I do want to discuss just the different ways that not having enough target stocks and do a really deep research, but only for a handful of stocks, and it might be a detriment. The first one, the first problem with that is that when you do a deep dive, a really deep research of only a few stocks, you really want to already invest in those stocks, because you become emotionally attached to them, and no matter how you try to look at things objectively, obviously that's your job, and there were of course many stocks that I researched and decided to drop really a lot. So it's not like I committed to every stock that I dedicated time to, but this time dedication does create a sunk cost when you already invested so much resources to this investment opportunity. It's really hard to decide that now you're not going to touch it, you're just going to drop it and nothing will actually come out of all your work. Not that I believe it's nothing, it's always a lot. You learn and you evolve as an investor, and it might come back at another day for a better price or a better opportunity. So you always get something even from a research you do where you do not invest, but still it's harder to decide when you dedicate, I don't know, a week, 2 weeks to research a company. And I don't want to be an advocate to not do that, because obviously all the biggest investors do that. But for me, there is a difference, because I'm a retail investor. I'm no Warren Buffett. I don't do that every day, all day long, full time. It's something I do on the side, so it needs to fit my schedule. And when I do not do that full time, I think that dedicating a few weeks or even a few long days, full days to one company really kind of clouds your judgment with it when you do become more emotionally attached to it, and it's harder for you to decide not to invest because you have little other options. If you do it full time and it takes you like 2 weeks to research a stock, then and of course if you have a team, then you research, I don't know, maybe 2,000 stocks a year. But for me, it turns that I eventually have really, really little stocks, little companies that I have researched, and I have really few alternatives, which make me more emotionally invested and really wanting to invest in the few I already researched. So what I feel it has caused me is to act in a certain way and to make some biases when researching the companies, where I feel that because I already wanted to invest in those companies, now in hindsight, at the time I thought I was being fair and I was really conservative with my estimates and with my evaluations and with my projections. But now that I look at it in hindsight, I think I did make some favorable valuations where I didn't for sure take not only the worst case, like the black swan event scenario into account, which of course always can happen and you cannot really value for it, but even the bad case where I knew most of my companies were cyclical, but I talked about in the previous video why I did that, so there was some logic to ignoring that. But I still feel like something in me just didn't want to kind of face even those bad scenarios. I kind of wanted to be overly optimistic about them, no matter how I tried not to. And I knew that's maybe the biggest pitfall for an investor, but I still feel I fell into it because I didn't have much alternatives, and I really wanted to invest in those stocks already. And I was telling myself this positive narrative, which I think for every company you can always tell, obviously, the positive narrative and the negative narrative, or even a few positives and a few negatives, and we have to tell ourselves some narrative, some story, to justify an investment and to build an investment thesis, unless we're, I don't know, quantitative or like more technical investors. But I feel like my narratives were more biased, and because I really wanted to invest in those companies already. I do feel that now, like something in me didn't take enough the risks into account. So it was also maybe in the naivety of a beginner investor, but I'm still a beginner investor now, and now that I'm switching a little bit the strategy, I already feel how I face much better the risks that are involved with the companies I research and decide to invest in. So yeah. So the next again obvious disadvantage of having really too few stocks on your target list is missing out on opportunities. And of course, you cannot catch every opportunity out there in the market. You cannot know every company, and we as investors should really control our FOMO when there is so much going on in the market, and we cannot really follow it all and be up to date with it all. I do think we need to focus somewhere, and of course, we should not be know every stock out there. But also, when you know, for me, it was like, I don't know, maybe 30 companies I was following only. I think that's really too little. Also, we need to find somehow the balance where you do follow enough companies where you can catch opportunities where they occur in the market. So maybe not every opportunity, but there will be enough opportunities in the next few years for you to grab. I think that's important. And for me, if it was only, I don't know, again, 30 companies, the chance of that is really too small for me to be able to fill my portfolio with those companies. So I do feel that if I would were to scan, and I did scan, of course, I did a lot of screeners, I did a lot of like superficial checkouts of companies, but once I realized that they were not going to be my one of few best quality companies, I dropped them. And I think that had led me to miss out on a lot of opportunities. And if I were not to do that, I would have done better until now. Where if I were to more superficially, less deeply analyze more companies, I would have got more opportunities thus far and would have done better so far. Also, again, it sounds super obvious, but for me it was not. And in case it can help anyone else, I think it's important to be aware of. So the next thing is the difficulty to recognize when your investment has not turned out well, and maybe it's not the worst, and maybe your investment thesis still holds on, but you kind of realize, and that's what I'm experiencing now, that I'm not gonna get the returns I necessarily thought I would from those investments, even if long term they're gonna be probably okay, those companies. And it's the feeling of heaviness and having a hard time to shift this capital either to back to cash or to other opportunities, like to give up on it, or even partially even to reduce the position. It's much harder when you did such a deep dive of the company. You have been following it really deeply for a long time. For me, I don't know if I can explain absolutely why, but for me, for those companies that I did that with, it's really hard for me to give up on them and to face the fact that maybe the returns from them are not going to be the best for me, and I could maybe allocate this capital to better opportunities. It's like a feeling that there is some anchor that is holding you to those companies, to those investments, where you feel less agile. And this agility motive, I feel, is gonna come back in future videos also, to shift your investments, to recognize that, okay, it's not playing out as well as I thought it would, so maybe I'll just shift it to other opportunities that I do see in the market. First of all, you see less opportunities in the market because you research less stocks, and you're not sure where even if I sell it, I'm not sure where would I put this money, and where do I allocate this capital as an alternative. But also it's hard to give up on, and it's every decision in the process of which stocks to analyze, which ones to buy, how much capital to allocate for it, the position sizing, how long to hold on it, how often to follow it and stay up to date with all current events and all the reports, and when to sell. All those decisions, like, I feel are much heavier, and I'm sure that some investors, maybe Warren Buffett, would say that it's a good thing that you have only a stamp of 20 points you can make in your investment life, and you should make only the heaviest decision when you have the highest conviction and really stick with them to the end. I'm sure this has a lot of advantages, and who am I to argue with Warren Buffett, okay? But this feeling of heaviness is definitely a disadvantage, because I think when you're more agile and more light to adjust yourself to what's going on in the market and what's going on with your companies, and with your strategy also, and your investment horizon, and I think there is something good in it also. And obviously there are also many famous investors who do a lot of changes in their portfolio and do sell and buy often. So it's just different approaches. And for me, I feel like this feeling of heaviness was really even influencing my consistency with investing. But overall, I would say that there is definitely a difficulty to switch and to shift from those investments. again, both because you don't have much alternatives and because you're so invested in them emotionally and you have such a huge sunk cost. So yeah, I think it's definitely, again, it has some advantages, I'm sure, but it also is a detriment. I definitely think so. So the next thing is the industry familiarity. So of course, when you go through a lot of companies and you check them out, you analyze, you read, you understand, you get exposed to so much. I feel it's super obvious, but just how important it is to know a lot of industries, to know a lot of markets, to realize even when our complete sectors, complete industries are undervalued because they're unpopular at the moment, or when they're overvalued because there's a lot of excitement and the exuberance around them, and to see different strategies of different companies and what's going on in the markets and different best practices and what's going on with even managements and the different properties of different industries, like the different characteristics of retail versus oil versus big pharma, or just realizing the different dynamics in each industry. You learn so much from. I think it's a must knowledge for an investor, which I felt I was acquiring this knowledge and this experience, but very, very slowly, because I was going through so little companies, and I feel like I did have also a learning curve, but it was a different one when I really did a super deep dive into each company, and it's also, you learn different things, you learn a lot from it too, but I did miss, I think, on this part of the learning, and I for sure think that it also affected my performance. That's that. The next thing is deploying cash. Again, obvious. I was sitting on a lot of cash. I didn't want to invest in ETFs, at least not the popular ones. It was hard for me, again heavy, to deploy this cash, because I was researching really only a handful of companies. I was doing this deep analysis, and I had only, like I said, about 30 companies on my target list, and I didn't know where to deploy this cash. And I was, at first I was kind of under an illusion that I'm gonna increase my tempo, and I will be able to analyze more stocks in less time, and I will take a hold of it, and that with time some of those, even 30 companies, would drop, and I will have those opportunities, and it takes some time to build the portfolio, which it certainly does, and that's totally okay. But it was too slow for me to deploy this cash, and with time I realized that it's really not sustainable for me to have a lot of really deep analysis for a lot of stocks, and also again it pressured me, the fact that I was sitting on cash while there was a crazy bull market. I really felt the pressure to deploy it already, which also made me kind of settle for less, because I really wanted to already invest in something, so I lowered my standards. So yeah, so that's about the cash. The next thing is that it's a very high effort, and again, obvious, but the fact that it's a very hard effort, I already mentioned it a few times, but I want to talk about it separately now, that it's really hard for me to be consistent with it. And again, super individual. Maybe someone doesn't feel that way. Maybe someone will sit through the night and read 10Ks and get a kick out of it. I also get a kick out of it. I love it. But it's really high effort, and it came to a point where it was really hard for me to just do on the side, to just I don't know, have 30 minutes minutes in the evening or an hour in the evening. I really wanted to like deep focus, and I would set expectations with my husband that he's gonna give me a few days like off almost, where I can just really get deep into one company and all its universe, and upload everything to my short-term memory, and to have like a nice picture of it. And I couldn't do that really a lot. For me, I feel like if I have to be honest with myself, even doing that every week is absolutely impossible for me. Every 2 weeks is gonna be really stretching it also. So even if I do like two really deep researches in a month, that would only bring me in the end of the year, after a year, to only like, I don't know, 15, 18 companies that I have researched, and that's still high effort. It's not, that's still a lot of work, which is, I love the work, but it requires so much resources, like mental resources and emotional resources. It really affects the consistency of it, and you have to like give it more a separate time. Whereas when I think you more check out superficially companies or do a less of a deep analysis of it, you can more do it like when you have 30 minutes here, 30 minutes there, just read something, just hear something, just check out the financial statements quickly. So it's easier than when you really, for me, maybe I shouldn't separate it like that, but that's how I feel. So yeah. So the next thing, and that's less about the fact that it's few companies, it's more a disadvantage that I felt really strongly with doing this really, really deep analysis of companies. And I'm saying really, really deep, and maybe it's all relative. Maybe someone will look at me and say, that's what you call deep. It's not deep at all. I check a lot of more things, and I read all the 10Ks, I don't know, a few years back, and I'm saying for myself, okay? I feel that when I really, for me, like researched everything I could about the company, I read the 10Ks, I listened to all the earnings calls, I read everything in the internet, all the reviews of the product, I read what employees were saying, what customers were saying, I searched for interviews with the management, I tried to realize who the management are, what's their deal, and their incentives, obviously. I digested all the financial statements and checked everything and tried to figure out and compare to previous years, everything, and read all the small footnotes and everything, which again, it's kind of fun. But I felt that that's it. Now I know the company, and of course, something in me knew that there's so much I don't know, but you get kind of an illusion that you know everything there is to know, everything that is publicly available, you gathered, and then you probably have an edge because of that, and you really understand the company and know it well. And what I came to realize after a while, that there is such a limit, such a ceiling to what I am able to know about the company, to my understanding of the company, no matter how much I research. I mean, there is so much you cannot control, and and so much that the company cannot control, and it's obvious. But even the things that the company can control, I don't even mean like control, like affect the outcome or affect the actions that the company is taking, but even account for. You cannot know in advance what the company is going to do, no matter how well you think you know the company or the management. I invested in a few companies that had really low debt, and that was one of the selling points for me. And lo and behold, they took that to finance some pretty risky strategies, and I did not expect expect that. I didn't think that fit the management, which I thought was really quality management and skin in the game management, which seemed to know their capital allocation. And now I don't think that way anymore, and I'm not sure. So I think that as much as you research, you don't really know what's going on inside the company, not as a retail investor at least. And the problem is that as much as you research, after a certain point, like every hour more you dedicate to the research, it gives you like a diminishing increased value, where every hour gives you less and less and less value in terms of helping you to make the investment decision. But it does affect negatively this illusion of knowledge when you think you know and you don't really know. And of course, it's also takes off of your precious time, which you could be spending checking out other companies and other investment opportunities. So I think there is some kind of a limit that I would put to how deep I research a company, also because of that and everything I talked about. Which brings me, to the conclusion. So that's what I'm gonna do. So for the time being, what I'm doing currently already is a kind of a strategy shift where I still look for value opportunities, but I am going to still analyze them. But I want to be able, because of everything I talked about in this video, I want to be able to sift through more stocks and analyze, but not as deep as I did before, and be able to again, get familiar with more companies, more industries, and recognize more opportunities in the market. And I'm already doing that, and I'm getting to that with those videos, where I kind of deployed a lot of cash already recently with this new strategy, and where I'm placing more positions, but smaller ones, which may be a little bit riskier, but maybe not. They have a different risk profile, which again I'll talk about. Stay tuned, and we'll see how it goes. I'm not gonna advocate for that now. We'll see how it goes for me. I already know this strategy did work well for me in the past, because while I was doing those value bets that I talked about, I was also doing kind of this strategy, and it was working for me really better. So I'm gonna stick with it more now. I don't want to get too deep into it now because it's a separate video, but on this subject, my conclusion is that I do want, for the time being, until something changes, or either my opinion or my lifestyle, to do less of a deep research for companies. So I hope for me it was really important to talk it through, to just be more aware of it, and to explain to myself too why I'm doing what I'm doing right now. If it helps anyone else, I hope it does. I'm really happy. See you in the next videos, where I kind of get to what my current strategy, which is working out pretty well already, kind of quick. We'll see how it goes long term, what it is, and what was my thinking process getting to it, and I want to get to really analyze companies, share my analysis. So that's what is expected in this channel, if anyone is still here listening. So bye bye, see you in the next one.